Afternoon, everybody. We'll kick off as it's 4 o'clock, and Chris has a very good reason for wanting to be somewhere else. Not that he doesn't love you as much as I do, but today is his wedding anniversary. And those men in the room will understand that if he wants to make it to the next one, he'd better get home to the Gold Coast as quickly as possible. So, give you Chris's background. I've listened to Chris present for the last 15 years or so. So probably didn't need the words sent to me, but I got them sent just in case I got them mixed up. Chris is the Chief Economist for BT Financial Group. He was the Chief Economist for Bankers Trust before that. He was also Chairman of the Indicative Planning Council that advised government on matters relating to the housing industry. He's worked for Treasury, the Department of the Prime Minister and Cabinet, and was for an economic consulting firm in the United States. Chris was educated at the University of Adelaide, which we won't hold against him, and the University of Pennsylvania. Ladies and gentlemen, Chris Caton.
Thank you. Thank you, Jeff. Thank you. Yeah, I hope it's a bit easier to get home than it was to get here. My GPS left me on the other side of the railway line. And that's okay if you know you're on the other side of the railway line, but when you know you're not at the RSL and you've got to find it. But hey, I made it. First of all, I'm going to do what I usually do, give you my view, if you like, of the big picture. The things that you hear about out there and you think, should I worry about that or not? And I guess general rule number one, there's probably less to worry about than you're told from time to time. But I'll come back to that. But I hope that under Jeff's care, if you like, you've had a great couple of years, good couple of years. You should have. The share market's done quite well. The share market, the Australian share market, for example, the index I look at now, around about, let's just call it 5,800. Mid-2012 it was 4,000. So if you've been invested in the past couple of years, you should have done okay. Admittedly, it was a lot harder before that, I will admit that. But so I hope you have had a good couple of years. I've had a very good couple of years. Thank you so much for asking. I'm not talking financially here. I'm talking about, because you've got a couple of lifestyle speakers after me, which unfortunately I won't be here for. But when we get up here, we talk about, I talk about finance all the time, but it's actually not the most important thing in your life, is it? When I say I've had a good couple of years, I'm not really talking about money. I'm talking about my life. One of the reasons for that is because in December 2012, I bought myself a very unusual Christmas present. I went out and I got a new left hip. And I discovered very quickly that hips are remarkably like wives. The new one is a vast improvement on the one I had before. But the transition is very painful and it costs you a lot of money. So it's very similar, essentially. This is a true story. I went back to see the surgeon a month after the operation. I said, I've just got the feeling now, my left leg, the one he operated on, is shorter than the right. And he said, no, that can't be. But sure enough, he measured it up, and it is. Economists, of course, refer to economics as an inexact science. Apparently, orthopaedic surgery, a bit inexact too. And now I think I've finally figured out why they say that doctors practice medicine. But he was very cheerful about it, actually. He said, look, don't worry too much about this. He said, I can fix this 3 or 4 years from now when I do your right hip. And I said, I've got no issues with my right hip. And he said, well, then you haven't looked at the x-rays. You will. Don't worry about it. So it doesn't matter how old you are, it does it. It's always nice to have something out there to look forward to. And that's what I've got. It also doesn't matter how old you are, you have to keep up with the technology, don't you? I'm sure everybody here, for example, has an iPhone. It's actually going back almost 2 years now. I took a big step on the what I think of as the technology highway. At the behest of my employers, BT, I got myself on Twitter. Now, everybody here has heard of Twitter. Some of you might be on it. Turns out one of the things you've heard about Twitter turns out to be absolutely correct. I got on in late May 2013 and I just went completely viral to this extent that by late September, so that's just 4 months later, in that 4-month period, I got 62 followers. Pressure was enormous. I think I had more followers when I was on RSVP, although they're called stalkers there, but it's the same thing. But back to business, back to the things that matter, if you like, the big picture. 2015 began in very interesting fashion because let's just put it this way, the economists and analysts that look at the global economy were sort of wringing their hands and saying, oh, it's all gone a bit soft and soggy again. And now ordinarily that would not be good for share markets, but as you know, share market's been on a tear. Not so much in the past couple of weeks, but even relative to the start of the year, the Australian market's up hugely. So economy's soft, but the market's doing well. What's going on? Well, one of the ways you square that circle, if you like, is you look at what policymakers around the world have been doing in response to the sogginess. And one thing they've been doing is around the world, interest rates have been cut. Somewhere between 20 and 25 central banks have cut their cash rate, or the equivalent of their cash rate, so far this year. Now that does two things to help markets. Number one, it convinces people that, hey, well, better growth's coming. And markets are forward-looking. They don't care so much what's happening now. They care about what they think is going to happen later. So that's good for the share market. But why else are lower interest rates good for the share market? Because it forces people into the market in search of yield, because you can't get any yield anywhere else. So that could be one reason why the softness, despite the softness in the economies, markets have done quite well. But it turns out that reason actually, the first of those, people have decided, oh well, the world will get better, doesn't stand very close scrutiny, as I can show you here. This is probably my most complicated slide. Every number here is a forecast, and it's a forecast for what economists call economic output, GDP, for this calendar year 2015. They're not my forecasts, they're put together by panels of economists and analysts around the world, and there are so many numbers here because these panels update their forecasts every month. So here's how you read it. First column, when these panels were asked way back last April, what's Australia going to grow by in 2015? What's New Zealand going to do, etc.? Those were their answers. Last column, the same question, but the answer is given this month, March 2015. Now you get the patterns here if you look along the lines, and you're looking for systematic movement. And if you may as well start with the bottom line. Yes, you can see that in the past 6 or 7 months, we've basically, economists have shaved about 0.5% off their growth forecast for this year. Now, as I said, ordinarily, I think of that as a headwind for share markets, growth prospects coming down. When you look above the bottom line to see, well, why has the overall growth forecast been cut? A standout for a while there was Germany, and you can read Germany as a proxy for the Eurozone, but you'll see, and I think this is an important part of the story actually, you'll see that around about August last year, Germany had one very poor month of data. And people started to talk about recession there and hence in the rest of Europe. And that was massively overstated. And you'll see actually that in recent months, Germany's growth prospects and the Eurozone's growth prospects have improved. And it may be no accident that the German share market right now up more than 30% in just the past year. So there's one sign that improving growth prospects do help share markets. But where else have growth prospects been cut? Well, a little bit in China, and China, it deserves its own story with respect to Australia, so I will come back to China. There's no other clear candidate, but I want you to look in the last, basically between January and February. See what happened there? Our global growth forecast was cut from 3 to 2.8. Now that's a big move in a single month. People were getting more pessimistic about economic growth this year. Now, look above that, and bear in mind the economies you've got there, that's a massive part of the global economy. Look above that and tell me why the global growth forecast fell between January and February. You can't, can you? Because it's not there. So if it's not these people, it must be somebody else. And I've been looking at these numbers for 15 to 20 years, and I've never seen this before. Global growth forecast cut, but not accounted for by the big boys. So I went looking for where it was happening. And I found 5 countries whose growth forecasts have been cut by a lot more than 2/10 in recent times. These are the weak sisters, if you like, of the global economy right now. I'll tell you the names of the economies. You tell me what they have in common. There was Canada and Russia and Venezuela and Nigeria and Saudi Arabia. What do they have in common? They are the oil producers. And to me, this is special topic number one so far this year, the oil price. Now, the index I follow, what they call West Texas Intermediate, $110 a barrel, June or July last year, $43 today. Now, normally what happens when oil prices fall? People rub their hands with glee. The consumer confidence goes up. People figure I've got more left over after I buy at the pump. Other consumer spending is stimulated and it's good for economic growth. But apparently not this time. Well, there are two explanations. First of all, look at a place like the US. Always a big story, of course. The US now produces more of its own oil than it used to do. And that's one reason why the prices come down. Their oil production has grown massively. But so more of the US labour force and more of their capital spending is now tied up in oil production. So when the price drops, they don't produce as much, people lose their jobs and capital investment comes down. So oddly enough, the fall in the price of oil so far considered to be a negative for global growth. Now this won't maintain. People will start lifting their growth forecasts around the world, and that's probably what's going on to some extent in Europe right here. Europe has been the weak spot in the global economy, but it's actually improving. It's going to grow slowly, but when was the last time that wasn't true? Incidentally, on oil, nobody can tell you, the oil price is at a 6-year low right now, $43. It was actually $44 in late January, so it's bounced and then come back. And that is a very familiar pattern. The last time, oil prices fall quite significantly, quite often. Something like 6 times in the past 30 years. And if you go back and look at what happens, you almost always get this double bottom. And you hit a trough, there's a dead cat bounce, and then you go back to it. And then prices begin to rise. And economists can't tell you that we're at the bottom right now. We just can't do that. We don't have the tools. But we can tell you what usually happens once oil prices hit bottom. And as I said, 6 episodes in the past 30 years where oil prices have fallen and then turned around and gone back up. If you just look at what happened after oil prices have troughed, if you just look at what happened in the next 12 months, on average, oil prices went up by 80%. Now, it still leaves them down, doesn't it? Put 80% on 43 where we're starting and you get to about 75. 80%. So this episode is going to turn around, and if you take nothing else from my speech today, at least do this, fill up on the way home. This is what's happened, as I said, to oil prices. This is what's happening on this occasion, and this is the average of the last 6 episodes, indexed so that the 2 lines come together right here. But it's phenomenal, is it not? And that's what usually happens next. Now, I said China deserves its own story. You'll see that 7% growth expected this year. If that happens, it'll be their slowest growth in about 25 years. And it's quite clear that the China story, or the change in the China story, has affected the Australian economy. Because 7% growth is a long, long way from what we were used to. In the 10 years to 2011, China averaged 10% growth for 10 years. And that growth was dominated by infrastructure and residential construction. That stuff used a lot of steel and iron ore. Steel used a lot of iron ore, so every year they bought more and more from us and paid a higher and higher price for it. And our industry said, we've got to get bigger. And we engaged in a mining capital spending boom, the likes of which not only have we ever seen before, but I don't think anybody has. And just to put it in perspective, the mining industry in Australia is 3 times as big as it used to be in the early noughts. 3 times as big. And then and incidentally, so the mining capital spending was a massive force driving Australian economic growth. But on top of that, on top of the boost from mining capital spending, we got a boost from the fact that because the Chinese demand was growing so much faster than world supply for iron ore and coal, prices went up. And we got a massive boost to Australian income. So we had a capital spending boom and a commodity price boom. And they are both over. Because when China slowed to a number beginning with 7, they're still actually buying more and more of our iron ore, at least they were last year. But the world supply and demand of the whole commodity industry has changed, so we don't get the price increases. So we had a capital spending boom was adding to growth. Now it's falling, subtracting from growth, because a lot of projects got cancelled when the iron ore price began to fall. The iron ore price in 2011 hit $180 a tonne. Then it went down to 90, then went back to 130, now it's below 60 again. So there's just stuff that's not worth doing that we thought was going to be worth doing. So mining capital spending a drag on the economy, and commodity prices have turned around and fallen, and I'll show you both these booms in a minute, and that's a drag on income also. So China is having a massive effect on the Australian economy right now. But as I said, they're actually still, well, the figures for January, February this year are a bit hard to interpret. They always are early in the year because of the Chinese New Year. But certainly until last year, China's thirst for our iron ore, hunger for our iron ore, was just growing. We sold them in tonnes. We sold them about 13% more last year than we did the year before. And here's a way to think about that. China's only growing at 7, and it used to grow at 10. But it's bigger. So is it not possible that 7% growth is as important as 10 used to be, in an arithmetic sense? And it turns out that's absolutely correct. If you put it in an Australian context, here's China's growth rate just through to 2013, so it's coming down to about here. This is the rate of growth of our major export markets, the columns. So what you do there is you just weight our major export markets by the share of our exports that go to them. Message number 1, we sell to the right people. World grows at 2.5 to 3, our partners grow at 4. The red bit shows you the share of that growth that's coming from China. And have a look at it. It has not taken a backward step. China's still a growing market for us. If they have a hard landing one year, we will feel that it is true. But they're still a growing market, but we're not getting the price increases. And if we don't get the price increases, we don't need expansion of the industry. So the mining boom is not what it was, to be sure. Here is the capital spending boom. Mining investment as a share of GDP went from less than 2 to almost 8 in less than 10 years. This is what's happening now. It was adding to growth and now subtracting. And the commodity price boom came right on top of it. This isn't quite commodity prices, it's what they call our terms of trade, the ratio of all our export prices to all our import prices. Countries are like businesses. You want to buy low and sell high. So you make the income gains when your terms of trade are rising. And as you can see, in 10 years, our terms of trade doubled. Now, if you do the maths and ask how much extra income did that mean for Australians, because this line went up rather than across, because our export prices rose so much more rapidly than our import prices, the answer is in 2011, the peak year, it was an extra $6,000 per head. That's massive, isn't it? Who here got their $6,000 from the commodity price boom? Annually? Nobody, right? Okay, first lesson, it wasn't distributed evenly, was it? Jenna Reinhardt got more than $6,000, I'm pretty sure about that, but that balances out pretty quickly because her kid's got nothing. And the patron saint of Queensland, St. Clive, he got more than $6,000. Yeah. I don't know how much more, I do know this, he's eaten it. I live on the Gold Coast, and for a bloke that's a member for Fairfax, he spends a lot of time on the Gold Coast. And about 6 months ago, I saw him coming out of the casino one night, and we stopped and had a chat. And he told me that he had just spent $100 on chips. And I believe him, and I don't think he was gambling. Now, you did get some of the $6,000. The biggest single way that the $6,000 per head was disseminated to ordinary Australians was essentially, there's so much affected when all this money pours into the country, in particular company income taxes. And the federal government of both shades did their best to get to bundle it back out as quickly as they could. During this part here, and indeed down to about here, we had 8 successive annual income tax cuts. We had all that middle class welfare, those superannuation tax concessions. This is the biggest single way that the commodity price boom was distributed to ordinary Australians. You probably still didn't get $6,000, obviously, but that's, and now of course, if somebody asked me to put up one chart to explain why the federal deficit is as big as it is, this is the one I would use. If that's puzzling you, we had a commodity price boom that was temporary. We enshrined it in the form of temporary tax cuts and spending increases. Because the money was flowing in. The money's no longer flowing in, but we're still shoveling it out. So as I said, And there's no relief coming in the near term here. Commodity prices, it's believed by most people, they'll drift approximately sideways from here. Now, I said the export boom isn't over. And this chart illustrates it. This is the rate of growth of the Australian economy through the September quarter, 2.7%. This is the share of that growth that came from iron ore and coal exports. Now, this is in quantity. The fact that their prices came down is not taken into account in this chart. But even as late as the September quarter, almost half the growth in Australia was coming from mining exports. And this is the bit that may weaken further in the short term, unfortunately. Now, coming to financial markets, when I put this together a few days ago, our currency 77 cents, 76 and a bit, when last I saw it. I've told every audience I've spoken to in the past 3 or 4 years 2 things about the Australian dollar. Number one, it had to come down one day. When we were above the US dollar, that was ridiculous. It was levitating. The other thing I told people, incidentally, is this, and I mean it sincerely, don't believe anybody. We're not very good at forecasting the currency. But my suspicion is that it's not done yet, that this episode still has a way to run, and we could well hit 70 cents at some stage of this year. Incidentally, frequently when I speak to audiences, somebody comes up and says, oh, gee, my travels, now my holiday's going to cost me more. Almost everybody gains. Well, let's put it this way. Almost everybody, if you've got your superannuation in some organised fashion, certainly if it's in a managed fund, you've got money invested offshore. When the currency falls, that money invested offshore becomes worth a lot more to you. And though your investment gains and your offshore investments are almost certainly going to more than pay for your extra travel costs. So don't worry about the extra travel costs when the currency falls. Coming down further, I'll come back to that in a minute. The cash rate, as you know, we cut in early February and then we didn't cut in March. Both of those moves surprised some people. You can rest assured that when the Reserve Bank cut in early February, they were definitely planning, they weren't planning on just one cut. Because if they were, they just wouldn't have bothered. So the plan always had a second cut in there. Now, plans can change. My suspicion is we're going to get that second cut. I realise it won't be good news for most people in this room. It'll probably be in early May rather than April for technical reasons. There are 2 things that will determine, what happens to these things are going to be the most critical determinants of whether we get a second cut or even if we get a third cut after that. And the 2 things are the unemployment rate, and I'll come back to that, and the other thing, and this is not always a consideration, but it is right now, the behaviour of investors in the residential property market. And I'll come back to those 2 things. I won't talk much about 10-year bonds. The share market, this is interesting. I think we're around 5,800 right now. On the 1st of January every year, I sit down and I figure out where I think the market's going to be at the end of the year, and I publish that forecast. And this year, on the 1st of January, the market was, I think, 54.20. So I thought, well, if the market went up in price terms by about 7%, by the time you added in the dividends and the franking credits, that would be a healthy return, and I think it's going to be a good year. So I put in 5,800 for the end of the year. I had no idea we'd hit my end of year target sometime in early February. But right now, I'm not inclined to change it. The Australian market has got a bit ahead of itself, in part, as I said, because interest rates have come down, and I'll show you a link there in a minute. But I think you can conclude this, that my forecast might be a bit pessimistic, it's true, but let's just put it this way, the past 2 and a bit months are going to be the best months this year. So if you haven't been in it, sorry, you missed the best bit. Now, on the currency, the red line here is the Australian dollar in US dollars, look to the right. The other line on the chart is what they call a trade-weighted index of the US dollar. And so that measures them against everybody they trade with. And now that line's inverted, so when the yellow line's going up, that's the US dollar going down. When it's going down, that's the US dollar going up. Now, because this happened for about 8 years, because the Australian dollar basically stayed very close to this trade-weighted index of the US dollar, I formed the view that the yellow line was kind of the right answer. That's where we should be. And I still think that. So this is my estimate of where the Australian dollar, in a sense, should be. So in a sense, we're still too high. It hasn't been a very good way to forecast it for a few years, has it? And it was a good way back here. So I will admit that. But as long as the yellow line is below the red line, I think probably more down than up. But there's one other thing I want you to look at while we're here. This is the Australian dollar last August, 94 cents. Here it is now, 76 cents. This is the US dollar last August. This is the US dollar now. Now remember, when the yellow line is going down, the US dollar is going up. Look at the magnitude of the US dollar rise and the magnitude of our fall, and the only thing you can conclude is that almost all, not quite all, but almost all of the fall in the Australian dollar in the past 6 months has been because the US dollar has gone up. So really nothing to do with us. And this, of course, is why if you're going to travel, don't go to the US, go to Europe or Japan or New Zealand, because we haven't moved all that much against them. We have moved a bit against New Zealand, that's true. Now, the share market, this is an end-of-month chart for the ASX 200. The index I follow, you can see we've been up 3 months in a row through to the end of February. Right now, looks like March will be down. Last time we were up 3 months in a row wasn't last year, was the year before. This roller coaster ride has done this to the market's price-earnings ratio. Now, price-earnings ratios aren't perfect, but they do tell you something. When the PE is high, market's expensive. Markets get expensive, why? Because people love them. That's oddly enough when people want to buy. When the PE is low, the market's cheap, usually because people are scared. This is where we were at the bottom of the GFC. This is where we were during the European debt crisis. By this measure, this is the long-term median, so by this simple measure, the Australian market's looking a bit expensive right now. But expensive markets can stay expensive, of course. But I want to show you, and this relates back to the point I made early on about low interest rates pushing people into markets and driving up the price-earnings ratio, if you like. This is what has happened. Here's the same thing we just looked at, the price-earnings ratio. This is the cash rate. Now, essentially, because I want to show that when cash rate's lower, the price-earnings ratio tends to go up, I've got to invert that. So low cash rates up the top, if you like, and high cash rates down the bottom. It is by no means a perfect fit, is it? And I'm certainly not arguing that in the current world the PE should be up here. But what I'm saying is the rise in the PE is perfectly consistent with the fact that interest rates have fallen. So it's not that the market's poised for a crash any day now. Incidentally, when I talked about the European debt crisis, I did occur to me. I left out one of my special topics at the beginning. I find it interesting these days because the special topics I talk about this year kind of go together. I talk about oil and I talk about Greece. Greece, as you know, is well. Let's come back here. No, I'm going the wrong way. Let's come back here. In late January, as you know, the anti-austerity party got elected in Greece, and if you cast your mind back to mid-2012, the anti-austerity party had a good run but didn't get elected. But although they didn't get elected, because they had a good run and people were concerned they would get elected, drag Greece out of the euro and financial chaos would result, there were repercussions all over the world. This is what happened to Australia's PE. This was sort of a debt crisis in late 2011. This is what happened during the Greece episode. In the month of May 2012, the Australian share market fell by 7%, almost solely because of Greece. In February this year, we rose by 6%, not because of Greece, but despite Greece. Nobody cares anymore. And my record's clear on this. I've said this all along. At the end of the day, Greece doesn't matter. It is just not big enough. And the anecdote I'd use for this is this, that the Greek economy is smaller than the economy of the city of Philadelphia. Now, can you imagine anything happening in Philly, and only in Philly, that you'd have to worry about? The Greece may leave the euro. That will lead to some volatility, but life will go on. The Greeks have renegotiated their debt deadline with the other Europeans from the end of February to the end of June. and that's why volatility from Greece has calmed down a bit. There will be continued volatility, possibly including in June, but volatility is not the same thing as depressant. And incidentally, there was, to me, what I think of as a favourite episode that occurred during since the Greek election, a couple of weeks after the elections. First of all, the Greeks had talks with all kinds of people about their debt issues, and the Germans hold a lot of Greek debt. So there was a meeting between the Greek finance minister and the German finance minister, and I'm not making any of this up. At the conclusion about how they were going to renegotiate the debt, and at the conclusion of the meeting, there was a press conference. And at the press conference, the German finance minister said, we had a robust discussion on many issues, and there were some things on which we agreed to disagree. And the Greek finance minister, and I'm not making this up, the Greek finance minister said, no, that's not what happened. So what does it mean when you can't agree that you disagreed? Because that's what he said. Greece has been a source of volatility, but not so bad these days. There is another source of volatility coming up, international volatility, and you will be reminded of this tomorrow morning. It's the United States. The United States has done very well in the past year or so. It's grown by close to 3%. Its employment growth has been, in the past 12 months, has been the strongest this century. Its unemployment rate in the past year has come down by almost 1.5%, and they've now got lower unemployment than we have. And yet their cash rate is still zero. If you asked a question of an Economics 101 student, if you gave them those parameters, the growth, employment and unemployment parameters, and said, what should the cash rate be in this economy, you would actually fail him if he answered zero. But it is zero. 2015 is going to be the first year that the US has raised interest rates since 2006. That is going to happen. People have taught themselves rising interest rates bad for shares, not necessarily when they take place in the context of a successful economy. But the point is this, that every time a Fed official says or does something that changes the market's perception of when the first rate rise will be and how rapid the rates will go up, markets react. And there is an important meeting concluding around about 3:15 tomorrow morning, our time, I think, of what they call the Federal Open Market Committee. There will be a statement issued. It will be analysed to death and over-interpreted. And I can pretty much guarantee this. I can't tell you whether the US market will go up sharply tonight or down, but there is a very big chance it will be volatile, and that volatility will carry on to us tomorrow. The shift is going to focus. The focus is going to shift, if you like, from Greece to the US. Now, just on the Australian market, while we're here, you all know this. I just thought I'd show you the picture. The line in the middle is the market. This only goes through the end of January, incidentally, and it says that in the 5 years to the end of January, the Australian share market was up by about 40%. The top line, it shows you what happened in the market excluding resources. And that's up, 70%. The bottom line shows you what's happened to resources. If you've been fully invested in resources in the past 5 years, you've done a lot of money. This is falling iron ore prices and falling oil prices. Now, I should say this doesn't have February in it. The resource sector actually had quite a good February. Now, there's one other thing about markets. We all know, don't we, that the US market has just thrashed us in the past 5 years. Both markets turned within a day or two of each other in March 2009. So we've just gone through 6 years, actually, since that happened. And we all know the US has beaten us. And I just wanted to show that in a slide. The top line here is the US. The bottom line, and it's indexed actually to before the trough of the GFC. It's indexed to 1 January 2009. So it's got the last bit of the GFC in it. And they have beaten us because we're the bottom line. Well, actually, we're only one of the bottom lines. The other one is what they call the developed world without the US in it. And we've kept almost perfect track, haven't we? Or phenomenally so. So it's really the US. It's not us that's done badly, if you like. It's the US that's done well. But I already showed you we're, if anything, a little overvalued, so they must be massively overvalued, right? No, they're not. If you look at our price-earnings ratio and theirs, this is what they look like. This is almost hand in glove, isn't it? They're a bit more overvalued than us, but not much. The main reason why the US market has done better than us is because they have out-earned us. Earnings have grown faster than theirs. Simple as that. Now that might be because they don't have as big a resource sector. Now coming back to the economics and the things that matter from the point of view of the Reserve Bank, the yellow line here is the unemployment rate, as I said, and I can almost give you a rule of thumb. Until it is absolutely clear that unemployment has peaked, there's always the risk of another rate cut. Once it is clear that unemployment has peaked, we will begin to raise rates. But that's probably a 2016 story. That's the yellow line. You can't be sure it's peaked, can you? You'd be a very brave man who would say that. The trend still seems to be upwards. And it's a lot higher, as you can see right now, than it was during the GFC. Hasn't been as high as it was now since 2002. The red line, incidentally, employment growth in this economy. We've got this idea somehow that the Australian economy is hopeless and can't generate a job. And yet we've generated, well, not quite, probably about 2.8 million in the past 15 years. The strongest employment growth, look on the right, it's not manufacturing, obviously. If you relied on manufacturing for jobs growth, you may as well give up. Mining has taken a tumble. The strongest growth sector in the Australian economy is household services. Now, this is not your pool man and your dog walker and your laundry person and your cleaner. This is basically education and health would be the two biggest components of that. And incidentally, if you look where employment growth has been by state, most of the employment growth has come in the biggest state and in the fastest growing state. No surprise there. Queensland's sort of interesting. We were doing quite well for a while, and as much employment growth as Victoria, but recently, and this might be one reason why the election didn't turn out quite the way some people thought it was going to. Poor old South Australia and Tasmania can't generate a job between them. Now, the inflation's only here because normally it matters for the Reserve Bank. They're supposed to keep, they're explicitly charged with keeping headline CPI inflation, the yellow line, between 2 and 3% on average over the course of the cycle. And right now it's less than 2. But that's mainly because of petrol prices. Because the measure they're trying to target gets kicked around by volatile stuff like that, they calculate this measure called underlying inflation. And underlying inflation also quite low, closer to 2 than 3 right now. This says, inflation is basically saying to the Reserve Bank, don't worry about us. But they have to worry about residential property. And they have to answer for themselves the question, have we created a bubble here? Because if residential property in Australia is in a bubble, the Reserve Bank has to take responsibility because it's come about because rates have been cut and held low for a long time. And that's going to push people into residential property. So let's have a look at that. We'll start with, these are actually indexes, not thousands of dollars. That's Brisbane, the yellow line, the capital cities of Australia, the red line. Here's how you interpret it. In the December quarter of last year, the median house price in Brisbane was 7.25 times what it was in early 87. So over a period of 28 years, gone up 7.25 times. Look at this bit here, this tick mark. We were raising rates here, cutting them there, raising them there, and cutting them there. So house prices these days, very, very sensitive to the interest rate cycle. But the question is are they too high? There are a lot of people who tell you they are, the bubblers. The bubblers do one thing. They calculate how many years' income it takes you to buy a house. And they usually get 7. They're wrong, but that's what they usually get. And they're wrong because they basically take the median house price and divide it by average earnings. So there's no second earner. There's no other income. But having done this, they say 2 things. Number 1, Australian houses are more expensive than anywhere else in the world. That turns out not to be true, although it's pretty close to true. We're up there. But the other thing they say is, and this is true, that measured relative to income, house prices are a lot more expensive than they used to be. That is true. But the main reason why it's true is because debt is so cheap these days. And so people load up on debt. And that's what pushes up the price. They use the debt to purchase. And that's why, incidentally, it's a related reason why allowing young people to access their super to buy houses is you've got to think very long and hard before you do that. Because if we've got a house price problem in this country, it's because we're not supplying them fast enough to meet demand. So if you just goose up the demand side by letting people throw more money at the houses, that's just going to put the price up. But back to the story. Are we in a bubble? Our house prices, as I said, we're not really that much more. We've got a lot of company up the top. Now I want to show you a chart. You've never seen this chart before, which would explain, even if we were more expensive than anywhere else, why this might be understandable. This shows you across the entire housing stock the square metres of floor space per occupant. Looked at this way, Australian houses are the biggest in the world. We've got 5 times the space of your somebody living in Hong Kong. Why wouldn't that make house prices more expensive? But as I said, they're not really. Now I want to show you a few more slides about houses, and I guess for the next 2 or 3 or 4, basically, I want you to, you don't have to yell it out, but when I put the slide up, focus on what you think is the clear standout on this chart. And for example, show you house price in thousands of dollars. What's the clear standout? What's happened in Sydney in the past year? Not so much in Brisbane by this measure, which is slightly different from the one I showed you before. Brisbane house prices aren't yet quite back to where they were a few years ago. Down here, regional's not doing all that well. Message, whatever's happened to house prices in the past 2 or 3 or 5 years has been massively a capital city story and not a regional story. Those are just indexes. That pretty much shows this. Since 2009, outside of capital cities, prices have gone up. It's about 15%, and this is about 35%. Massively a capital city story. Now, once again, what's the standout feature of this chart? My next chart shows you the increase in house prices by capital city in the year to February, and the overall number is quite high, 8.3%. But what's the standout in this chart? And it is simply that this, the house price story is being massively driven by Sydney. According to this chart, in the year to February in Brisbane, house price up a bit less than 6%. And try telling the residents of Hobart or Perth there's some kind of bubble going on. They're not going to believe you. Now, I want to show you, incidentally, that figure up the top, middle of last year was probably 10. So house price inflation is moderating. When it was 10, the Reserve Bank said, this is okay, we don't think there's a bubble, but we don't want 10 again in the next year. And it doesn't look like they're going to get it. But this is starting to show you that if there is a problem, it's concentrated. Now I want to show you, incidentally, not what's happened in the past year, but what's happened on average in the past 10. All right, so it'll look very similar to this, but with the figure up the top will show you what house prices have done on average in the past 10 years. Annual rate. So in your mind's eye, figure out what you think that is. And just as a mental exercise, which capital city do you think is up here? And which capital city do you think is down there? And where do you think Brisbane is in the mix? And here are the answers. On average, in the past 10 years, house prices have averaged 5% growth per year. Doesn't look like much of a bubble, does it? The top and bottom, Darwin's up the top and Hobart's down the bottom, just as like in the real world, really. And Brisbane's not really outperformed, has it? I don't see a bubble in Australian property, but nor am I particularly optimistic about house prices over the next year. If we do 5 or 6, that'd be a good result. Now, the Reserve Bank said that all along, but in late September last year, they changed their tune. And they said, we're still not worried about the overall market, but we are worried about the pace of investor activity in Sydney and Melbourne. Now, that is how much they pinpointed it. Now, if you think you've got a problem in housing, there's a very easy way to fix it. Just raise interest rates. That'll do it in a heartbeat. But the rest of the economy doesn't need higher rates. So if you've just got a localised problem, investor activity in Sydney and Melbourne, you need a localised solution, laser treatment if you like, and And that's why they've involved APRA, and that's why APRA is talking about macroprudential tools, including getting banks and other institutions slow down the rate of growth of credit to investors, etc. Or maybe increase their capital requirements. Here is, I just want to show you some slides that illustrate why the Reserve Bank's worried. This is the rate of increase of mortgages outstanding. These are for investors, and this is for owner-occupiers. So investors are driving this story, but it's nowhere near what was happening in the early noughts. Not even close. Now, when investor credit was growing at 8 to 9%, Glenn Stevens, the governor, basically said, yeah, this is enough. 8 to 9 is a bit heavy, we can handle this, but we don't want it going higher. It's gone higher. So their worries increased there. And I want to show, this is the stock of mortgages. I now want to show you, for the new lending that's done every month, how much, basically the share of that new lending by Australian banks and financial institutions that goes to investors. And that's what it looks like. Spot anything? In the past 5 or 6 years, it's gone from like 33% to 50%. Investors are just dominating the market. Now, don't sit there thinking, oh, it's the Chinese. These are basically loans. This is the share of the loans from Australian banks and financial institutions. Money that's coming in from offshore only adds to this. If there is, the residential property boom is not being driven by the foreigners. They're, if you like, the cream on the top. But the Australian domestic investors are doing it to themselves. Now, this is the share of that's going to investors. I now want to show you in dollars, if you like, and looking at the individual states where investors are borrowing money and how that compares with what they used to do. All right, so see if you can spot the standout thing on this chart. I think everybody's got it, haven't they? Essentially, a few years ago, investors were borrowing $2 billion a year in New South Wales, and that figure's now bigger than 5.5. Queensland, incidentally, I wasn't living in Queensland in 2006, but you must have had a bit of a party here then. And we're still not back to that level. And remember, this is like 9 years later, and prices have been going up. But investors are borrowing less now than they were at the height of that particular episode. There is a problem with investor borrowing in residential property. So if there are signs in the next couple of months that that's still going on, so if you're reading stories about houses going for $1 million above the reserve, about auction clearance rates, record highs, etc., the Reserve Bank's going to be reluctant to cut rates again. But I actually don't think that will happen. I think that investor activity will calm down a bit. And incidentally, if the investors basically borrowed the money and then went out and bought a new house or paid for the construction of a new house, the Reserve Bank would say, that's great. That's economic activity. One of the strong bits of the Australian economy in the past year, the Australian economy in the year to December grew at about 2.5%. Mining investment was falling. There were a few other things that were quite weak. Consumer spending did okay. Residential construction of new properties grew by 12%. So it is helping a lot, but it's not the investors. This is the share of loans to investors that actually go to put for new construction, and it's very low.